2021 is going to be a central bank year. Between the ECB, the BOE, the Fed, the BOJ, even some of the smaller central banks, Australia, Canada, Switzerland, some of the Nordics, we recognize that central banks have sort of entered this new era of capital market support, monetary liquidity, monetary stimulus. And that is in the face of what has been quite a challenging market for some cash investors with zero interest rate and negative interest rates. It's been really challenging. I mean, probably the number one question we got all year from our global cash clients is, what do we do about negative interest rates? What do we do about zero interest rates? How do I avoid them? How do I mitigate them? What else can I do to enhance my cash returns? And so when I think about what US policy rate will be in 2021 and beyond, I think we'll be pegged at zero for quite a long time. My forecast has no interest rate hikes by the Fed for the next 10 years. And I know that sounds ghastly to say, and I apologize to those that are cash owners, but I'm not trying to confuse zero interest rates for the next 10 years with negative GDP or underperforming GDP. Quite the contrary. I think that economic growth in the US will be strong and robust, but it's just that the Fed is going to keep rates very accommodative for a lot longer time to ensure that full employment is reached. For the euro, the ECB, it's interesting, and this is an important point to note here, because what we've done is we've reached sort of the bottom of interest rate monetary policy by central banks. So if you look at the Bank of Japan and the ECB, during the March period, they were the only central banks that didn't ease policy rates. Really every other central bank had a little room to ease, some a lot, but some, for the most part, at least a little. And so with that in mind, we think about the ECB in terms of providing quantitative easing or continue to provide liquidity into the markets. And that's definitely what we're seeing really across developed markets, is central banks are entering a new paradigm by which they will enact their policy by providing liquidity, by buying assets, by providing funding, by providing backstops. When we look at core PCE, which is a metric that the Fed looks at here in the States, and we look at it over the last 20 years, it really hasn't held above 2% for any extended period of time. When we look at inflation in Europe and in the UK, it's a similar story. We've just had a harder time holding inflation above what central banks are sort of using as a 2% benchmark as far as measuring the effect of inflation. And I think most recently at the end of the last economic cycle, from 2018, 2019, when we saw really, really low unemployment, very high levels of employment, we just didn't see inflation moving into the cost of goods, the cost of labor, et cetera. And I think there's a couple reasons for that. One, we are more global now than we've probably ever been in the history of the world, which is really quite remarkable. And that globalization is coming in a variety of forms. It's coming in, and certainly in the manufacturing side, and we've seen that happen over the last 30 years, 40 years. And then services, right? We are all now working from home for the most part in the financial service sector, and in many corporate treasurers are now sitting in their home doing their job, and that's really amazing. So what we're able to do now is distribute service level workers, which had been something that was has only been a very recent phenomenon with technology and Zoom meetings and WebEx meetings, et cetera. So that's another reason why I think it will be harder for inflation to be a concern, because we have this ability now to potentially find the lowest cost locations to do any particular type of work. So I don't worry too much about inflation in the coming years. I mean, certainly geopolitical risk is always a concern, a challenge. I think with a change of administration here in the States, we're probably going to go back to a more quote unquote normal political operating environment, and perhaps less volatility around certain tweets and certain news headlines and certain ways of doing things. So I think that's something that we're certainly, I think for the most part, people are looking forward to a sort of more calm and orderly environment here, which hopefully will diminish some of the geopolitical. But geopolitical risks are always out there, and they're always a challenge. I think from a treasurer's standpoint, liquidity is really important to look at as far as how it could be impacted by any sort of geopolitical tension or any sort of really halt in economic activity. And that's exactly what we saw in March. And one thing treasurers have now, which they didn't have until the period of March, is they've got sort of an extreme example of what a stress test looks like on the market. And the great news is we've got tons of data. We can see what the mark-to-market impact was on some of their money market funds. We know what the liquidity profiles of the money market funds look like. And so we can look at that, and then we can use that in our analysis, and we can evaluate what our liquidity looks like. So, we've always talked about this diversification and making sure you certainly don't have all your eggs in one basket, but not even having a few in several baskets. Now it's like having one in a whole bunch of baskets. And so I think that's something that treasurers should look closely at. And then they should just run hypotheticals. Okay, well, what happens if I can't get at this money for a period of time? What do I do? That, the CEO taps me on the shoulder and says, I need to pay for this or I need to pay for that, but you don't have access to that liquidity. What are you going to do? So we have that data now, we can look at it. And so I think this is really beneficial. The one thing that I know corporations need to focus on, are there any contracts that are linked to LIBOR? If there's a late payment, does that late fee get charged off of a LIBOR index? If there's some sort of an overdraft, is your charge assessed? Is there some sort of performance measure that's benchmarked to LIBOR? So there's a lot of things that are sort of hidden. And so the thing that we're doing now is really going through with a fine-tooth comb and making sure we look through every portfolio. Delay in US dollar LIBOR potentially out to 2023. That's not saying that LIBOR will exist post December 21 for the purpose of writing new instruments to it. It's simply saying that they will allow it to exist to help legacy issues roll off of it. So they've recognized the complexity of some legacy issues, like perhaps contracts or other things that are linked to LIBOR that are harder to novate off and onto the new index, whatever it is, if it's Esther, if it's Sonia, if it's SOFR here. So that's certainly not saying that we're delaying the end of LIBOR. It's simply saying we are giving people a little bit more time to work on some of those legacy contracts. So we are preparing for the end of LIBOR in December 2021, both in all of the currencies that we manage to. We're taking steps, but we're also recognizing that issuers are also taking steps. So for example, an index that we manage to is about 25% smaller in size. The index is about 25% smaller in size, simply because issuers have called in or tendered in bonds that they do not want to have outstanding because they are benchmarked against LIBOR. So, and we've seen that happen in other assets as well. So asset-backed securities, for example, credit cards and autos had typically been issued as LIBOR floaters, and we're now seeing those coming as fixed rate bonds. So this is something that we're keenly aware of, and recognizing that the market is sort of naturally shrinking. March put money funds in Europe and in the United States through a pretty significant stress test. And I think the good news is we got through it. The good news is we saw really significant redemptions, and we got through it. Managers provided liquidity. Folks were able to subscribe and redeem. There was no gates, there was no fees rolled out in Europe or in the States. And it was super challenging. There was so many sleepless nights, so many days that felt like they never ended. But we all got through it. We've got a lot of great data to study. We've been in continuous communication with regulatory entities, regulatory bodies. We've been in communication with our clients. And I think everyone is very focused on looking at the details, looking at the data, and just making sure that what is either in place is right and should be in place, or if there needs to be changes, there will be changes. I've commented that I think the variable NAV for U.S. prime funds worked well. I've commented that the LV NAV structure is certainly phenomenal in design, but it did cause quite a bit of tension amongst folks that were managing those funds as the mark-to-markets dropped, and it's all public information. You can see that some of those mark-to-markets came very close to the 20 basis point collar. But I know the European regulators are going to take their time and look at that, and there's a proper review slated to come out in 2022. And so I think that that time frame will be here before we know it, and I know that they'll make the right decision around what the path going forward is. But I think ultimately the most important thing in all of that was that there was really healthy disclosure, and so clients are really able to see what happened and what went on. And that's really important because clients need to make informed decisions about what's the right product for them, what do they want to be invested in. They need to be able to look at the cash flows, see what the volatility was, and all of that information is available for them. So I'm very optimistic on the industry. I'm very optimistic that the regulators will make a proper studied approach, and ultimately will continue to evolve into a better product, as we have over time, over 30 plus, 40 plus years that these fund structures have been out there. We continue to evolve and they continue to improve.